Hey everyone, it's Ian here. I'm a dividend stock investor. I spent all weekend researching PPL Corporation, IBM, and Disney. These are three companies right now that are making moves like Craig Mack with Puff. There's a lot of news with them, a lot of news going on, and in two of the cases, they're talking about spinning off divisions, splitting up companies, and so sometimes when there's a lot of activity like that, it can create value. It can create opportunity for long-term dividend investors like myself. So I want to cover these three stocks today, and I want to also cover them in light of what happened with United Technologies. United Technologies merged with Raytheon, and so then you got Raytheon Technologies and they spun off Otis and CARR. So this is a company that recently made moves, and there are some interesting results from their moves. Long story short, the moves that they made unlocked a lot of value for shareholders like myself. And so I look at that lens when I am investigating other companies thinking about doing something similar. A lot of insights in the video today. Get ready, everyone, for an exciting dividend stock video. All right, everyone. So before we even get started, please hit the like button. Please comment below, subscribe, show some love, show some support. It means the world to me. I literally did spend a lot of time preparing for this video today. So I want to jump right into the United Technologies case study. I'm going to show it on the screen right now. Once again, United Technologies is no longer in existence. It's now three companies: Raytheon Technologies, Otis, and CARR. And so I'm a long-term shareholder of these entities. And going into the split, they basically acquired Raytheon and then they split into three companies. Going into that, I did acquire a lot of shares. I kept buying and buying because I saw the long-term value in this entity. And now that the split happened, I do continue to manage it as one single company. It's now three tickers in the portfolio, but I kind of look at it as one. And that's really the basis of the analysis that you see on the screen right now. At the top of the screen, what you see is I just look, hey, the last time I kind of ran my stock portfolio, it was right after the split up. It was on April 16th of this year. And if I look at that through today, if I just look, I haven't been adding more money to these during this time period. What am I up? What kind of value has been unlocked by splitting the three? If I just look at the amount of money I had in it before, and then I sum up the amount of money I have in it now, if I look at all three entities combined, what happened? Well, I'm up 29.3%. And over the same time period, the S&P 500 is up 25.7%. So unlocking these three companies, splitting them up, it actually allowed them to surpass the performance of the S&P 500. Now, if this never happened, if they never acquired Raytheon, if they never split into three, would they have beaten the S&P 500 as one entity? I don't think so. I actually don't think so, because for a number of years, United Technologies is kind of a sleepy company. It's just kind of humming along. And I do believe by breaking it into three companies, it did unlock some value. And so what's so interesting is I didn't know that. I didn't really know it would unlock the value ahead of time. I just knew that, hey, I love this company and I wanted to buy as much of it as possible before they got split up. And one of the reasons, quite frankly, I wanted to do that is I knew I wasn't going to sell CARR, I wasn't going to sell Otis. And by putting a lot of money in them, I just wanted to make sure that those positions were large enough that when it was split up, they wouldn't be so insignificant in my portfolio, because I didn't want some really small, insignificant positions in the portfolio. But check it out on the screen right now. Some of the things that I learned out of this is, again, that the split up, I believe it probably unlocked some value, especially in the short run in terms of share price appreciation. Now, to be fair, I'm a long-term dividend investor, and so do I like seeing this value created? Do I like seeing this capital appreciation? Yeah, it feeds my ego. However, honestly, over the long run, I probably would be better off if the split up didn't happen, if the stock just kind of languished, because I invest for dividends, and the lower the stock price, the more dividends I can buy with my money. That being said, hey, it's a positive outcome. It's nice to see. And one of the things I want to mention here is there's this activist investor. His name is Loeb, and he actually supported breaking UTX up into 3 companies, but he did not support the Raytheon merger. I am mentioning this later because we're going to talk about Mr. Loeb in the case of Disney. This is a case study I'm going to discuss in the video later today, but I just want to plant the seed that he was, I give kind of activist investors, hedge funds, I kind of give them some constructive feedback here from time to time. But I'll tell you, in this particular case, I was maybe a little bit skeptical of the activist investor coming in and telling United Technologies to break into 3 companies. You know what? He didn't like the Raytheon merger, but he did like breaking it up into 3 companies. And you know what? I got to give props. He was generally right. He was right that it unlocked some value, again, at least in the short run. Now, remember that because we're going to talk about Disney later, and my gut reaction is that I don't like what Mr. Loeb is suggesting for Disney, but hey, maybe he's right. Anyways, I want to plant that seed. What else do I want to update you here? You can see on the screen right now that just a ride or die update. UTX, or now the 3 companies, RTX, Carrier, Otis, they didn't quite make my ride or die list. Look, I own 46 dividend stocks. Only so many can be on the ride or die list. Those are my favorite ones. The reason these ones didn't make ride or die is because of the uncertainty. Now that we're past the uncertainty, and honestly, I'm glad we are. I'm glad it worked out. And I can see kind of more clearly at least one of these companies is going to be in the next 5 that come after ride or die, like a close runner up. And again, that will probably be Raytheon Technologies. And so, but again, you can see here the capital appreciation is nice and it feeds my ego. But again, there's 2 sides to every coin. And the flip side as a dividend investor is with everything surging in price, gives me less opportunity with my dollars right now to buy more cash flow because everything has run up. So I want to take a quick look at these 3 stocks. You can see on the bottom of the screen right now. And Raytheon Technologies, just a quick look at that. Of the bunch, this one is the most undervalued. It is trading right now at $60.54, and the forward PE next year, 2021, is in the 15 range. Starting dividend yield of 3% and a market cap of $92 billion. Personally, this will be a close runner-up to my ride or die stocks. This is something I've been discussing recently. I'm going to have a video soon that talks about the next 5 favorite stocks after my ride or die. Raytheon Technologies will be on that list. And quite frankly, I'm going to be buying more of this one now. I feel that it is trading at a reasonable valuation. And in my overall dividend stock portfolio, I don't have a huge allocation to the defense sector, and so this is my defense sector play, and so I don't mind having a little bit more money in it. I'm going to add to that one shortly. Let's look now at the other entities that used to be part of UTX. Carrier, if you just go to Yahoo Finance and you look at the stock chart, both Carrier and Otis, they have performed extremely well over the last months, basically since they became entities that were trading on their own. And Carrier, you can see it's only yielding 1% now. Payout ratio is really low, so it has a lot of room to grow the dividend. Hey, the PEs are okay. Forward PE this year is 22, next year 18. So it's not really overvalued territory yet, but it's worth a lot more than I thought it would. I never thought that Carrier was going to be a $28 billion company, and so that's really interesting to see. Otis, it's overvalued. I mean, look, the PE this year is a 28. Next year, 26. Dividend yield is only 1.2%. They have a lot of room to grow the dividend because the payout is low, but payout ratio is low. But what's so interesting is the market cap. Again, it's 28 billion and change. If you had asked me before these things split apart that Raytheon Technologies would be kind of languishing and Otis and Carrier were going to skyrocket, I wouldn't have predicted that. And that's why I'm saying that sometimes looking at these case studies, it helps everyone grow as an investor. And this is how I learn as an investor. I do this research to grow my knowledge and hopefully impart some of that knowledge here for fun and entertainment on YouTube. And anyways, that's what's so interesting here from this whole case study is they did something different. They made some moves. They split apart and look, it worked out. But even though it worked out, I'm going to still be buying some Raytheon Technologies because of the bunch, that one is the most undervalued. And it seems like an interesting stock opportunity right now. And so with that backdrop, I want to move on now, and I want to move on to PPL Corporation. So check it out on the screen right now. What I want to do with PPL is I want to just start with some high level notes, and then I want to get into some specific screenshots from the corporate literature that the company put out. PPL Corporation is a regulated electric utility that I own. It is a great yielder. It is perpetually undervalued. Look at this thing. It's trading at $28 and change with a PE in the 11 range. The starting dividend yield is 5.7%. They grow the dividend, but not much, just under 2% on average per year. And the payout ratio is low. It's only 69%, so there's room to increase the dividend. At a snapshot like that, I personally think that PPL Corporation is an interesting buy right here. I will probably buy more because they are making moves. They are doing some very interesting stuff here that, quite frankly, this is way out there, but this could be an opportunity to buy shares of yet another United States regulated electric utility on the cheap. And so I want to show you how I'm arriving at that. So check it out on the screen right now. What they're doing, what they're talking about, is they're likely going to sell their UK division. This is a very big move because 52% of their net income comes from the UK. And they just bought the UK division in 2011. And what was interesting, when they bought the UK division in 2011, they said, hey, it's going to unlock value. Our earnings are going to increase to the 250 to 275 range for 2011. Well, now the EPS is estimated at 242 this year. There's been no stock splits in between. So one of the first things I just want to highlight here is this company is not like United Technologies, Otis, or CARR. Those are growth companies. Those ones are growing. They're dividend growth companies. PPL is growing the dividend, but I look at it more as kind of a proxy for a bond, if you will. It's a high yielder. It's a current yielder. It gives me cash flow now that I use to pay my bills or could use to pay my bills. Some of my cash flow I actually do use to pay bills now, but I don't use the cash flow from PPL just yet. But basically, this one, it's not growing. The EPS is not growing. And so you can even see just from 2011 compared to 2020, EPS is not growing. And so what it is doing, though, is it's spinning off cash flow, and it will do that in perpetuity, in my humble opinion. And it's a sizable cash flow. So if you're someone who potentially needs cash flow today, that's the kind of stock that this is. But I don't kid myself. No one should kid theirself. This thing is not going to offer a ton of capital appreciation. But check it out on the screen. The reason that I'm pointing this out is sometimes moves are kind of, you're making moves to make moves. And it's like, hey, they bought this thing in 2011 and now they're selling it in 2020. And yeah, in between, maybe they could have never predicted a global pandemic. Maybe they could have never predicted just political stuff with Brexit in the UK and just certain people in politics in the UK that want to nationalize electricity. There's a lot of factors going on here. There's a lot of laws and just political stuff that they probably never envisioned. But that being said, it is kind of interesting that they just bought it to sell it, and that the margins are really good, and that it's over half of their net income to do so. And so I'm just trying to provide a fair and balanced opinion on this thing here, that there are pros and cons to what they're doing. But hang on there. Keep going with me because I've got some more things to share on PPL. So basically, the pandemic is hurting commercial energy. I'm going to show that on a slide in a minute, and it's especially hurting their commercial energy in the UK. They want to strengthen their balance sheet, but it's interesting. Why strengthen your balance sheet in such a low interest rate environment? Again, is now the time to sell off the UK division to pay off debt? I don't know, but if they do foresee that there's a lot of risk in the UK division, hey, maybe. But the way I look at it is a lot of that risk has passed on by. They don't have some of the political risk that they had just a few months ago. Anyways, PPL, it's great. It's great. It's like a bond. Here's where it gets interesting. PPL recently added the former Southern Company CFO to their board of directors. Some people speculate, hey, Why get rid of this UK division to strengthen your balance sheet in a low interest rate environment where a lot of that political risk that was there in the UK a few months ago is gone? Why do it? Because the interest rates are low. It's easy to borrow money now. Interest rates are going to be low for a long time, I believe. Why do that? Well, what some people believe that could be one possibility is, hey, they need to sell off that UK division to position their US counterpart to get sold or to get acquired. And potentially there could be a buyer out there like a Southern company or like a Duke Energy, which are two companies that I own and I love and I like more than PPL. And so then that gets me thinking, hey, at a PE ratio of 11, hey, at a starting dividend yield of 5.7% with a good payout ratio, not too high, not overly paying out, why not buy a little bit more PPL here and just wait and see what happens? It's kind of like UTX. I bought a lot of it before they split apart. Then I just kind of waited and wait and see what happens. Hey, it worked out for me. I would not be surprised here with PPL with the moves that they're making that it actually works out and that it works out in my favor. And so here, it's not a ride or die stock for me. It's kind of ancillary in the portfolio. But the way I'm looking at PPL here is maybe I'll buy a little more because when they do sell this UK division, it's possible they're positioning themselves for something really interesting, and this would be a cheap way to get into Southern or Duke if one of those bought it. But even if they don't, I think that dividend yield is here to stay. The PE ratio is really low, and I think that they're selling the UK division. It creates some uncertainty, some value in the stock, and so I think it's a really interesting stock at this time for dividend investors who need current income, current cash flow, and a lot of it. So with that, I want to quickly go just through a few slides from PPL Corporation because I think these slides provide a world of knowledge for dividend investors, a world of knowledge and key takeaways, if you will. So check it out on the screen right now. I want to start just with the PPL business structure. What you can see here is they have regulated electricity in Kentucky, Pennsylvania, and the UK. And the UK comprises roughly half of their net income, of their earnings. And so they want to sell off that UK segment. And you can see on this next slide right now that the UK segment, again, is roughly half of their net income. You can see that on the slide on the screen right now. So moving along to the third slide, what I want to show you is just a quick press release. It says PPL completes the acquisition of the UK electric distribution business. And so it says here, this was in 2011, and basically I did this just to timestamp when they bought it. Moving on to the next slide here, slide number 4, check it out. This is from the same thing in 2011, and it says, as a result of the transaction closing, PPL has increased its earnings forecast up from the prior forecast, and they're saying, hey, this is a good thing. This acquisition is going to be a really good thing for the company. And so I love the internet because it has all this historical data, because now when I go to the next slide, check it out on the screen right now, what you can see is, okay, in 2020, they're going to sell it, and what's going to happen? It's following a comprehensive strategic review. It's going to unlock value. And so what's so interesting is these people were telling me this is going to unlock value in 2011, and now in 2020, by selling it, hey, it's going to unlock value again. This, honestly, with any company that's making moves, it creates uncertainty. I think that's one of the reasons that PPL is trading at the prices it's trading at now. And it kind of does put a little skepticism in my mind that they were making moves just back in 2011, and they're making moves right now to undo what they just did. That's kind of a con of it all, if you will. But sometimes making moves to make moves, it unlocks value. It creates a temporary buying opportunity. And that's kind of how I'm looking at it as a long-term dividend investor. So moving on now to the next slide, what you can see here is a dividend profile. This company has a long-standing history of growing the dividend, and they will probably continue to do that. And so that's something really exciting to see. Now, on the next slide, what I want to show you right now, check it out on the screen, is what the pandemic has done to them. And one of the reasons, quite frankly, they may be selling their UK regulated segment is UK is getting hit harder. You can see here that residential use across the board of electricity is up. Commercial and industrial is down. Total is down, but it's down the most in the UK. And so maybe one of the reasons they're selling off UK right now is for this very reason. The other reason I'm sharing this slide with you right now is to provide a lens, a light. If you invest in utilities like I do, you may be wondering right now, why are the utilities down? Right now, in uncertain times, why are the utilities down when investors tend to flock towards regulated electric utilities during times of uncertainty? One of the reasons that they're down, quite frankly, is what you see on the slide, is that electricity consumption is down. And one of the reasons that it's down is the commercial consumption is down. And so that's something I think electricity, utility investors, all of us need to be mindful of. I think this is a golden slide from their recent earnings report that sheds a lot of light what's happening right now in the regulated electricity segment. And so with that, let me just move on to one last slide. Check it out on the screen right now. These guys plan to basically sell the UK business. They want to position it as purely US holding company. They want to use it to strengthen their balance sheet, this and that. And it says it could include strategic growth opportunities in the US, returning capital to shareholders. And they think they can get a good price for WPD. That's their UK division. And so, again, pure speculation here, but how interesting it would be if this were a backdoor, if you will, to get Southern Company shares or Duke shares or some other shares on the cheap. And so net, there's uncertainty with PPL right now. They're making moves. I like it. I like some of that uncertainty when it's just the right amount of uncertainty. And so for me, as a dividend investor, I'll probably buy a little more, but this is nowhere near my ride or die list. It's not on the next 5 stocks that come later. It's an ancillary position for me, but I have no problem buying a little more PPL here when a lot of stocks in this market are valued at such a crazy premium. All right, everyone. So with that, I want to move on to the next segment of the video today. By the way, put in the comments below, do you like PPL? Do you own it? Give a thumbs up if you like PPL Corporation. Would love to hear in the comments below. And so with that, I want to move on to the next stock today, and that's going to be IBM, Big Blue. So check it out on the screen right now. I want to start with some statistics from IBM, and this one gave me a little trouble. They are talking about splitting into 2 companies, and so before we even get there, let's just look at the basics. This thing is trading at 127 and change. Earnings are good, $11 this year, $12 next year, so your PE is in the 11s and 10s. Dividend is a 5.1% yield, low payout ratio. Dividend is growing. All around, honestly, as far as the market goes now, IBM, it ain't a growth story, but it's got I'd say it's kind of between PPL and the United Technologies family of companies, or Raytheon, Otis, and CARR. I'd say Raytheon Technologies, Otis, and CARR, they're dividend growers. Those are companies that are growing, that will grow the dividend over time, but give you a little lower dividend in the short run. PPL, it ain't growing, but it pays a nice steady dividend. I'd say IBM is somewhere in the middle. It's growing a little bit, but not much, but it pays that healthy dividend. But IBM, if they can figure stuff out, and we've been waiting, us shareholders have been waiting a long time, but if they can figure stuff out, there is an opportunity there for that company to not only provide a high current yield, but also a lot of growth at the company, like Raytheon Tech, Otis, and CARR. And so there's that wild card, there's that opportunity there. And that's what I think IBM is trying to do. And so check it out on the screen right now. What's happening with IBM? Well, before we even get to that, there's a lot of moves happening right now in the cloud space. TikTok actually is the US division. It looks like there's a strategic investment being made, a acquisition being made, and the 2 players that are involved are Oracle and Walmart. By the way, go Walmart. That is a company that I own and I love. And so I'm so excited about that. And what this just goes to show is TikTok is going to be powered by the Oracle cloud. Everyone's in this cloud space. It's really competitive. And I think IBM is trying to find ways to remain competitive and to promote and grow their hybrid cloud experience, which has been fueled by that acquisition of Red Hat. And so I kept searching and searching and searching. Why are they doing what they're doing? And I'm going to get to it in a minute. But before that, check it out on the screen. I just want to go through a few more bullet points. Gives a good backdrop. Revenue is down at IPM, just a little bit, 1% adjusting for currency and divestitures. EPS is way down. This is the first 6 months of 2020. It's down 26%. Free cash flow is down 10.6%. Tough year. And so IBM is, that being said, free cash flow is still really strong. They can easily pay their dividends, so on and so forth. Rough patch, rough year, but I think they will be just fine. And I think that earnings will come back. But I certainly think that right now IBM management is thinking about what types of moves to make to reinfuse the growth, because they've been trying for a while. And at a certain point in the technology space, the growth has to come. Look, regulated electric utility like PPL, we don't need any growth. It's fine. Steady Eddie. No one's coming in to take over their business. It's regulated. It's a monopoly, if you will. IBM, other people like Oracle can eat their lunch, so they need to grow. And so what management is thinking, split into two companies. One company, the core IBM, it's going to be focused on hybrid cloud, AI, all that good stuff that's part of the growth trajectory. The other company, they haven't named it yet. It'll be called NewCo, or they'll come up with a better name for it. But that one is going to basically include kind of the back office infrastructure type, managed infrastructure work that they do. And so, by the way, I'll tell you, IBM, one of the reasons I love them so much is they power a lot of the big companies all throughout the world. Back office stuff, you don't even see it on a day-to-day as a consumer, but when you go to the bank, for example, and you work with the teller, with the ATM, that has to be powered by something. A lot of the time, it's powered by technology from IBM. They power a lot of back office systems. And so this managed infrastructure, if you will, it's a very exciting and interesting space. But they want to split the two. And I was wondering, why are they splitting the two? Are they just trying to make moves like UTX did to unlock value? Or are they just doing it to do it? I would say I kept searching and searching and searching. I really did not come up with a good reason for it until I found the screenshot that I want to share with you on the screen right now. So check it out. It took me a lot of digging to figure this out. And there's one statement that finally clicked with me why they're making this move. And what was so interesting is it says, NewCo, again, this is the new company, the managed infrastructure. This is the third paragraph, will also be able to partner fully across all cloud vendors, opening new avenues for growth while maintaining strong strategic partnership with IBM and continuing to serve existing and new clients. This is important. Read this paragraph. Here's the deal. There's almost a conflict of interest. Let's say, for example, that IBM is working with a big bank and they power all the back office stuff and they make a lot of money doing it. That's the managed infrastructure, the NewCo. But let's say, because it's all one company, IBM, they're in a kind of a conflict of interest. When the bank needs cloud infrastructure, IBM's really pushing the IBM cloud. But I think what's happening here is they're potentially losing sales or almost harming themselves because the two divisions of the company are competing with each other. But what if the bank, for example, wants to go with that IBM back office infrastructure, but they don't want to go with the IBM cloud. They want to go with the Amazon cloud, or they want to go with the Oracle cloud. They want to go with something else. By splitting the two, I think it gives more flexibility to the customer. The customer now can work with their managed infrastructure on the back end, but they can select any cloud vendor. Now, will this hamper IBM cloud sales? Maybe, maybe not. I also think there's benefits here for the legacy IBM company, which is going to include the cloud stuff. Because quite frankly, I bet you IBM on the back end has some bureaucracy. And I bet you there's a lot of kind of just overhead at the company. And I would say by splitting the two companies, they probably each become more nimble, more flexible, more adaptable. And so I think by kind of putting the cloud stuff separate, they're probably learning a lot from what worked at Red Hat as more of a startup, as more of a nimble company. And so I'm hoping that the cloud division can grow substantially as well. And so I'll put just the stats back on the screen again. What you see here at IBM is it's a company in transition. The revenue is going nowhere. EPS is down. Free cash flow is down, but I think it'll come back. Valuation is bargain basement. Is this a ride or die stock for me? No. Is it a stock I'm looking to really add more of here? Maybe, maybe not. Look, out of everything I've talked about today, I want to add to Raytheon Tech. I'm doing it. It's close enough to my ride or die. I have to stick to my ride or die strategy. It's in the next 5. Am I adding to PPL? Maybe I'll buy a little here or there just because I love the current yield. And I have a suspicion with PPL that there's going to be a series of moves that unlock some good value. Am I going to buy IBM here? Probably not, but am I happy as a shareholder what they're doing? Yes, I am. I feel good about the moves that they're making, and I think it works out on both fronts. So kudos to the IBM management team for doing that. So with that, I want to move on to the last stock today, which is Disney. Check it out on the screen right now. This is another favorite of dividend stock investors, and what you see right now is a company, quite frankly, that's facing some challenge in 2020. I don't own this stock, but I have purchased it for both of my kids. It's in their portfolios because they have a really long-term time horizon, and that's what I think you need with a company like this. But the EPS estimate this year puts it at a 79 PE, and for next year to 47, so it's trading very high. They've had to shut down, parks this year, amusement parks. They've lost revenue, lost earnings. It's been a tough year for this company during the pandemic. The dividend yield is really low. It's 0.7% because they actually decided to pause their dividend for the first half of the year. And so I took that out of the equation. I'm assuming they pay the dividend in the second half of the year, but I don't know what will happen. The payout ratio, it's actually still high because they're earning so little, and the dividend growth has been negative. That being said, look, the reason that someone invests in Disney is not because of what's happening now, but what's happening in the future and the types of brands that they own with the Star Wars franchise, with the Disney Plus streaming service, with the amusement parks, with the Frozen franchise, with all of the amazing trademarks that they own and content. You're investing in the long term. You're investing in the fact that Disney has resonated with families for decades and will continue to do so for decades into the future. And will Disney still be here a century from now? I am pretty sure that it will be. It will stand the test of time. That's why someone would invest in Disney. But there is no doubt about it. There's a lot of red boxes on the screen right now because all the metrics are looking really bad. That being said, did they need to halt the dividend or suspend a dividend for the first half of the year? No, they didn't. There was a lot of drama. I'll link in the description below. There's a lot of political stuff. For whatever reason, one of the reasons I don't like Disney as much is for whatever reason, this stock gets attacked by just in like kind of political sense. Like Abigail Disney, who is the heiress to some of the Disney fortune, she was saying, hey, cut the dividend, don't pay the dividend because it's not fair to the people who lost their jobs at Disney because the amusement parks were closing down. Now, my heart goes out to the people who lost the jobs, but also some of those very same people who lost their job are probably Disney shareholders. And so by cutting the dividend, it hurts the little person. It hurts the little person. So I did a whole video on this. I was hoping that Abigail would see it because I wanted to provide a different perspective to her viewpoint because dividends are for everyone and dividends empower everyday people. And that's the whole purpose of my dividend investing channel here on YouTube. Anyways, they didn't listen to me. Disney didn't listen to me. They cut that dividend anyways. But it now seems that Mr. Loeb is back. Dan Loeb. I was discussing him earlier because I was skeptical when he said to break up UTX, but that panned out. But Dan Loeb is back and he's now saying, hey, Disney, cut the dividend again. Just turn it off for the second half of the year. Use the money that you save to reinvest in your streaming business and to create more content. Because he said if you do that, Disney Plus and Disney as a whole could have a much higher valuation. It could be worth a lot more like Netflix, because Netflix trades at a premium valuation. So he's saying if you stop paying the dividend, you use that money hey, for more streaming, more content, more reasons for people to sign up for Disney Plus, hey, you might be valued similar to Netflix. And so originally I was skeptical of what Dan Loeb was saying, but again, maybe he's right. I don't know. These days, hey, you get older in life, you come to realize that you're just not always right, and that you should always look at all the perspectives. That's kind of where I'm at. And so I think he has an interesting perspective. And so I want to share on the screen right now just a few thoughts with this whole situation with Disney. And what are Ian's opinions? And so, well, I like Dan's idea, but I don't know if they need to halt the dividend to do this. The cost of capital is cheap now. Interest rates are low. Why don't they just borrow some more money or issue some more shares to fund more content? Why cut the dividend? Why cut that legacy? Because so many people rely on the dividend, and Disney may lose shareholders over that. So that's one of my first thoughts. Second thought, again, interest rates are low. Capital is cheap. Third thought, as I said, this company just in particular, it seems to be prone and open to more controversy than I would have expected with something like this. It always seems to involve itself, and I don't know if they just attract it because it's such a well-recognized brand, but now with Dan Loeb and before with Abigail Disney, they seem to be like just under fire. It's just interesting. I mean, I own Sin stocks, and boy, I thought those were under fire. I thought Disney, which is friendly, family-oriented company, why would they be under fire? But they are. And that's just a takeaway as well, though, in the society that we live in, dividend investors taking a step back. There's certain people out there, they don't like us collecting our dividends. They don't like it because they think all dividend investors are just ultra wealthy people who kind of are taking advantage of others, sitting back, doing nothing, collecting their dividends. The way I look at it is anyone collecting dividends from dividend stocks, they work to acquire that, or someone in prior generations in their family worked hard to acquire that. And so I don't subscribe to that line of thinking at all, but taking it a next step, there are a lot of little people, normal people, everyday people who rely on dividends. And so just some of this hatred that comes towards dividends, it's been personified through Disney, but especially through Abigail Disney and her viewpoint. But the way I look at it is, could this be foreshadowing the future? Are dividends at risk? I don't know. We shall see, but it surely gets one thinking about the political landscape for the future. And I think it's just a little sad that the dividends do get attacked, because dividends are something that are accessible for everyone. And so it's a means for everyone to go about improving upon their life. Now, Disney, I own in both of my kids' portfolios, or they own in both of their portfolios. Will I be buying more? There's been enough happening with Disney this year. I'm not so sure I will. I think next time it's one of their birthdays or it's the holidays when I typically add to their positions. I like buying stock for them rather than gifts, rather than material things. And I don't know if I'll be buying Disney. I might be looking at another position for them. I have a few that come to mind, but one is WD-40 and another is McDonald's. Those are two positions that I've had in mind for them that may be better bets than Disney right here, just with everything going on with Disney. But surely I never sell dividend stocks. Same goes for the stocks I bought for my children. Those are buy and hold forever, and I'm sure over the long run, Disney will flourish. So to summarize everything today, I kind of went from, I would say, best to worst. UTX, or now RTX, I love it. PPL, I like it. IBM, I like it too, but I'm probably not buying more. Disney, I don't like it, but maybe Mr. Loeb is right. Maybe he's not. We'll see what happens, but I don't like what's going on with Disney this year. Share in the comments what you think below. Would love to hear. With that, I want to add a friendly disclaimer today. Today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. Man, investing in the stock market, it carries a lot of risk, especially right now in 2020. In terms of a full disclosure, I own many of the stocks mentioned today. I am long PPL Corporation, ticker PPL. I am long Southern Corporation, ticker symbol SO. I am long Duke Energy, ticker symbol DUK. I am long IBM, ticker symbol IBM. I am long Walmart, ticker symbol WMT. I am long Raytheon Technologies, ticker symbol RTX. I am long Otis, ticker symbol OTIS. Long Carrier, ticker symbol CARR. And I am long McDonald's, ticker symbol MCD. And both of my kids are long Disney, ticker symbol DIS. I own all of those stocks in my personal dividend stock portfolio. And then Disney, my kids own in their stock portfolios. Hey everyone, I'm trying to reach 100,000 subscribers here. Please subscribe if you enjoyed the video today. Show me some love. I will see you all in the next dividend investing video. And before I go, thank you to all the generous patrons who have been supporting my channel. I love you all. It helps me do what I'm doing. I'll see you all in the next one.